Let's start off with Astrapak. The company's fully diluted headline earnings per share plunged 37.1% year-on-year for the year to the end of February to 73.5 cents from 116.9 cents for the year under review. The packaging group's turnover grew to 2.71 billion rand from 2.61 billion rand. Astrapak said it remained optimistic about its prospects but cautioned that higher oil prices and anticipated interest rate increases would exert pressure on the economy, consumers and the industry as a whole over the next 12 months. Gentlemen, on that note, welcome to Hot Stoxx. Simon, let's start off with you. SWOT analysis on Astrapak.
Market cap 1.2 billion, price earnings 10, dividend yield 2.4. That's taking today's numbers into account. Headline earnings were down 37% at 73.5 cents. Warren, I want to come to you first. I mean, the packaging companies, and I remember way back in the 80s, my mentor explaining to me, you know, packaging's simple. When times are good, you buy them. When times are bad, you sell them. I appreciate we've had maybe the toughest times ever. We're kind of coming out of it. I'm not seeing it in these numbers. These guys are, to my mind, struggling, and the industry should be doing a bit better.
Yes, absolutely. Packaging companies are cyclical in nature. I think they just had a really tough year all around. They had some labour action strikes which affected their bottom line. They had retrenchment costs which crept in there. And then, of course, polymers are greatly affected by the price of oil and petroleum. So those came in as well, and that's why we saw also a plunge in the cash generated from operations, because they went and spent money on their inventory, anticipating problems with the prices continuing to rise and shortages in stock. So I think it has been a combination of a whole series
almost
of factors.
a perfect storm. You're saying maybe it was just one of those years which you just want to forget about.
Definitely, I think it's one of those years they want to forget about, but I think the economics in the business, in the packaging industry at the moment, are still very tough. I mean, just one thing that stood out for me was that they grew revenue by 4.9%. That was on the back of a 1.4% decline in price. So that's average prices across the board. So it shows you that that competition really ticked up this year, and it affected prices even when some of their base costs were rising quite rapidly.
It was quite fascinating. A very good evening to you, Anthony. Welcome to Hot Stoxx, and it's the first time you're joining us. Let's delve into the price war that is going on, and of course that resulted to a slight increase on the revenue front because there is that competitive environment which is playing out. You also mentioned, Warren also mentioned the retrenchments and of course the industrial action as well. So perhaps, yes, a perfect storm, but it seems that Astrapak has got a strategy in place. Can they overcome all these difficulties?
Well, it doesn't seem to me that they are in control of their margins. They're under incredible margin pressure. You've got input costs really linked to the oil price that are really squeezing them on the input side, and they're finding it very difficult to grow their sales price through this increase in competition. So, I mean, it's going to take some really kind of hard work by management to right the ship. They seem to have suffered a legacy of problems from an ill thought out acquisition strategy or binge acquisition strategy some years ago, and they really are just trying to right size the business, but again it's very dependent on an increasing consumer environment, and the consumer in South Africa is tapped out. It's still suffering from a lot of debt, and it's going to take time for them to be able to regain this pricing power.
They're not dominating in this space either. They operate in many different areas, and within the packaging space they don't dominate, and hence, as you said, and to Warren's point, where they managed to push the volumes up but the prices went down, they can't exert their dominance, and that's perhaps one of the issues that's also hurting them. If you're the big player, you can kind of throw your weight around a bit here. They haven't got any weight to throw around, is my sense.
Absolutely. I think in this game you really got to dominate a niche. Carve out a niche for yourself, like Winhold, for example, Gundel Plastics. That has a really good dominant niche in agricultural bags, fertilizer bags, mealie bags, they're polyethylene bags and polypropylene bags, and they do dam liners as well. So they dominate that niche. And then they've got a great growth strategy into Africa. These guys seem to be trying to be all things to all people, a little Nampak, and it really hasn't paid dividends.
So what would you like to see them niche themselves within? What space?
Yeah, I'd like them to find a space, I don't care where it is, but a space where they dominate, where they can set their margins and defend the margin. It would probably be in a value-added type sector or product. I think that, again, they've got to, really look at the costs and, you know, focus, you know, have a laser focus on costs. And, you know, then you are kind of geared towards a recovering consumer.
Warren, you mentioned inventories up some 25%. And you also said that really it is them just positioning themselves ahead of the oil price, which was rising. So is it more that in a sense, rather, is it what, buying forward or something? Because I saw this and I thought it was, you know, plastic bags and tin cans on the shelves.
Yeah, look, it is. It's, as Anthony pointed out, you want to, in the packaging game, you get your margins from being a really specialist niche player. And part of my skepticism with this company is that they're saying that they aim to be the lowest cost producer. If you look at the competitive environment they're operating in, they're competing against Nampak. And along all these lines, you know, you have, it's not a business that can lend itself very easily to scale because most lines are very specialized. So yes, it's a big industry, but there's so many little small niches that make up that industry that it's hard to bring scale there. They've also been talking about doing this for the last 2 years, where they talk about this investment in advanced technology, which will run down costs. But again, it comes back to the scale question. I don't think you can bring scale into this type of business to such a degree when you're faced with competitors the size of Nampak.
And in the 2 years, they were optimistic last year and they're optimistic this year. Anthony, I mean, cash generated down 18%, cash on hand down 40%. Is that a factor of those input costs, which is oil, which is Eskom, which is, and to a degree, strike action, etc., really hitting them? And really, I mean, they're sitting on 80-odd million in cash at the moment. Sorry, no, yeah, 80-odd million in cash.
Yeah, interestingly, they've maintained the dividend. So it can't be too stressed from a cash position. But, you know, to see that cash burn is concerning.
Warren, with regards to scale, I mean, you were talking about that perhaps Nampak is in a better position than the likes of Astrapak. What is the next move? Do you think the company should be taking, you know, a forward-looking approach where they say, let's get into Africa, let's take that risk and expand even further so we do increase our volumes extensively? Or is it about getting the local operations right first?
I think they've got to get the local operations right. As far as I'm aware, they operate almost exclusively in South Africa. Nampak, as we'll discuss, I'm sure in a few minutes, are well ahead of the curve in terms of getting into Africa, and they've got a very careful strategy. So to kind of this, and moving into Africa is not something I've heard them speak about as their expansion strategy in this for Astrapak. So they've got to be very careful. They've got to start with their base, which is obviously South Africa, and they need to, as Anthony points out, find niches where they can play. Nampak's been offloading businesses that haven't been producing. You would expect a competitor like Astrapak, a smaller player, to pick up some of those businesses and try and create niches where they can. And I think that would be the basis from which to go forward on.
In other words, you're looking for the company to embark on the acquisition path, essentially, would be a good strategic move.
Buying smart, if they can do, but first and foremost is that they need to correct the strategy. I'm not sure you can be the lowest cost producer. So you need to be a niche player where you can find those margins, and you need to pursue that strategy quite carefully.
In a sense, a complete overhaul. Stop trying to be the low cost, find the niche. So, Warren, Astrapak for you, hot or not?
No, not hot at this stage.
Not at all.
Not at all. Did you gentlemen ever hold Astrapak at any point?
No,
Warren?
no, we haven't. No.
Okay, fantastic. Simon?
Not hot, and I think I owned it when listed way back in the late 90s
what made
or
you
something
buy it?
like that. Packaging. Yeah, it was boom, it was .com, it was packaging. CDs need to come in boxes. Never worked. Bad investment.
Right. I won't ask you how that trade ended up, okay? Shouldn't I? I don't think so. Right, we turn our attention now to Nampak. It expects headline earnings per share and earnings per share from continuing operations to be between 20 and 40% higher for the 6 months ending in March, from 72.8 cents and 75.9 cents per share previously. The packaging company said that the increase in earnings were due mainly to improved results from flexibles, diversified canning and African operations. Nampak, a company perhaps in better stead than Astrapak.
Yeah, I think so. Market cap 15 billion, so significantly bigger brother. Price earnings 14.7, dividend yield 3.0. Those will obviously re-rate when the results come out. With a 20 to 40% increase, you could drive a bus through that. That's quite a wide range. Anthony, let's come to you first. I mean, Warren mentioned Africa. Elaine, they mentioned Africa in the update as well. It's still small. Sub-Saharan Africa, it's 12 countries, it's 7% of revenue, but you get a sense that they've really thought this out, that they're going carefully and slowly. They're doing very well in Nigeria. They've got a 10-year deal with British American Tobacco to supply cartons. They're dividing Africa up into a couple of regions. a lot of the problems which beset companies in Africa, such as supply chains and the like, they really seem to have worked around them and worked through them and doing it methodically.
Yeah, it goes back to the idea of dominating a niche. So if you are the biggest bottling plant in Lagos, for example, you can set a price.
Yeah.
You can drive out competition. You can, really focus on value add and defend your margins. So, my sense with Nampak is that they have picked the low-hanging fruit. They've closed down loss-making operations. They've sold off non-core businesses. That's the easy part. The hard part now is to execute on the strategy. The stock is also re-rated. So, whether it's going to be a great investment, going forward from here, it has been a great investment over the last 12 months, remains to be seen. We've kind of a little bit muted in our kind of earnings growth expectations. We think that it's fully rated. In other words, it's not likely to get re-rated higher from here. But it is on a fantastic dividend yield, forward dividend yield of about 5%. So, I think we've got a 2-year target price of about 24 Rand. It's trading at 22. So not a huge amount of upside. Most of the return you're going to get is going to be from the dividend.
If you think of the potential in Africa, and we keep saying this on the show, if you think about how many cans and bottled goods could be sold to 1 billion potential consumers, it's all about securing those right customers as well. So we're working closely with the likes of SAB and British American Tobacco and so forth. When it comes to Nampak, they're also expanding here in South Africa. They're looking at a new glass bottling manufacturer as well. So a lot of things happening at one time. Do you think that they are in good stead at this point, Warren, or do you think they're overextending themselves?
No, I think they are in a much better financial position, as Anthony said. They've come from the Jack Welch school of business, where they've fixed, closed, or repaired or got rid of businesses that were underperforming, and that is the easy part. They had 20% of their businesses were not making profits, so they said, right, we haven't proven to establish a competitive advantage in these businesses. Let's get rid of them. Let's close them down. Let's sell them.
Such as the European paper and healthcare business as well. That was the most recent.
Yes, and the flex and foam. I think they sold a flex pack and foam business, which was inside their flexibles business as well. And then from the African side, as you point out, 1 billion consumers. They've got a very carefully thought out strategy, which they've been executing for a couple of years now. So they are involved in those SADC countries. And just one thing I wanted to clarify is that they have both an established presence in the countries where they talk about a 1.3 billion Rand in revenue, and they also export into those countries, which is a further 1.2 billion. So altogether, as far as I understand it, it's
almost getting a double whammy. I want to come back to the point Anthony made it, you certainly made it, around Astrapak, which is dominating that niche. And if we bring it back to South Africa and aluminium cans, they dominate the niche, 100% of the market. Wonderful place, but I would worry that the Competition Commission is going to come knocking. I mean, is that power perhaps also a little bit risky? And the big thing is, in particularly in aluminium cans, is barrier to entry is humongous. You don't just set up a new plant. They probably dominate there. Isn't there some risk of being too big?
I don't think so. I think in the packaging industry and with the cans there, to understand how closely integrated a packaging company is with a supplier like an SAB Miller, they are extremely intimately connected. So that type of monopoly comes from a client relationship where they are almost, I mean, for want of a better word, they're almost an operating subsidiary of SAB Miller. That's how close the relationship needs to be. So I don't think there's going to be too many competition concerns there, because of how closely integrated they are with their customers. But just in terms of that African strategy, I mean, it still is some way off, and that's the reason why I think the share price is fully priced. Is that it only accounts for 8% of revenue at the moment. And they're only really planning on growing that to 20% over the next 5 years. So the question is, where is the growth going to come from in the meantime if you want to re-rate that share? And at the moment, I just don't see that.
Okay, so hot or not, I'm assuming you're going...
Fully priced, so
fully
no.
priced. No, so if you hold Astrapak, Nampak, would you be holding on to the stock at this point?
I would be holding on to the stock, yes.
Okay, but no new money allocated to Nampak, all right.
Again, not hot.
Not hot.
I like this man, short answer.
Yeah, short answer.
no
reason why.
justification.
Yes, you did say it's fully priced at this point.
Yeah. I like it, and compared to Astrapak, absolutely, I do like them, but I got to agree with our two guests. I don't know where they're going to boom that share price.
Trading margin only at about 5.5%.
Yeah, small trading margin at 22 Rand. Am I going to do brilliantly? Nah. Am I going to make money? Yes. If I were a holder, I would stick in. I wouldn't put more cash into it.
Fantastic.